Thanks for jumping back into Lamb's Cryptoverse. Today we're going to discuss something that's more educational. That's the difference between short-term and long-term charts. So let's get started. First of all, when I look at anything, basically, I take it from a holistic point of view. I try to take in everything. And this requires looking at a top-down analysis, bottoms-up, the macro environment, meaning global macro, what's going on with interest rates, what's going on with currencies. I try to look at fundamentals, and I need both long-term and short-term charts because not one factor or chart is going to tell you everything. By the way, on something on the side, it looks like I'm really obsessed with charts because that's all I seem to talk about. But I do spend a lot of time, a lot of background time looking at the fundamentals, whether that's a particular crypto project or that's a particular company. I do spend a lot of time looking at income statements, cash flow statements, and whatnot. But for all intents and purposes, today I'm going to be discussing how to look at charts and how to distinguish between the two. It's pretty easy, but it's always a good thing to remind yourself, what am I looking at? So what are the key characteristics of short-term indicators? It's pretty easy, right? You know it when you see it, but sometimes it's better to just review it. Like you can see here, they oscillate, meaning they move up and down a lot. They're more technical based, and they tend to be more top-down oriented, right? They tend to look at the forest rather than looking at the trees. And of course, they're macro based most of the time. Some people might argue that they're a lazy man's way of looking at things because they're more technical based. And so you don't really need to spend the 100 hours you need to really get to understand the data behind the charts. But that's for another day to discuss. So the key characteristics of long-term indicators is that obviously they tend to oscillate or move with less frequency, so they don't move around a lot. They're more fundamentally based. They tend to be more bottoms-up indicators, so you tend to look at the trees more than you're looking at the forest. And they're more micro data based rather than macro data. So think of when you were in school, you studied macroeconomics and macroeconomics. And to me, they're more important when they signal. So I think that should be right away before we even get to the end of this presentation. I think we should stress that for me, they're more important when they signal, when they give a signal. So let's look at some examples of short-term indicators. One example is from ETF.com, and this is fund flows. These flows move around all over the place. So as you can see here, over the last few weeks and months, there's been an outflow from gold funds. So I interpret this, as usual, as a contrarian indicator. Everyone, as I like to say, everyone and their mother, or maybe their grandmother too, is selling gold funds. And recently, gold prices went down to something around 1,700. And I think they can go even lower to maybe 1,500. Why? Because the Fed's increasing rates, so liquidity is getting tighter. So when liquidity gets tight, you see asset prices decline, and then not just gold asset prices, crypto asset prices too. But that's for another day. So basically, fund flow is an example of a short-term chart. Another example is a put-to-call ratio. This moves all over the place. So now we're at 0.75, and at the end of today, we're probably going to be 0.8 over the September 16th, September 17th. We're probably going to be 0.8, and that's showing from a contrarian point of view that investors are starting to get bearish again because they're starting to buy put options again. But again, this moves all over the place. Now here's an example of a long-term chart. This is one of my favorite charts. This is the percentage of stocks that are above their 200-day week moving average. And this doesn't give many signals. To me, it gives a really good signal when we're 10% or below. And we saw that in March 2020. We saw that in the end of 2018. And during the great financial crisis of 2008, we not only went below 10%, but we stayed there for quite a long time. This is one index that gave me I shouldn't say a false signal, but I thought we had bottom when we had the Lehman crisis, because many indicators gave a bullish signal in September, October of 2008. But the bottom was not hit until March of 2009. But you could see the signal was pretty low and stayed low until March 2009. So it's still a very good chart. It's a very good signal, indicator, I should say. Another one is, you remember I mentioned fundamentals? Another good long-term fundamental indicator is the price to book value, whether it's for the stock market or even for stocks. And I put these stocks because they're very unique, number one. And number two, you should always do your research, look behind the numbers. Like Tesla stock's gone down a lot, but why is it a 26 price to book value? Is it overvalued? Or, I expected it to be much lower because Tesla has positive cash flow, and all that cash is going on the books, right? So that should be lowering its price to book value. But I suspect the price to book value is 26, meaning it's high, because that Tesla has burnt a lot of equity over the years. So that also means that maybe we should not be looking at the price to book value for Tesla. Instead, I like to look at enterprise value to revenues. And if you look at that, it shows that Tesla's EV to revenues are much lower than they were over the last 2 years. And I chose Salesforce here because, again, you should look behind the numbers. Salesforce has been influenced by acquisitions. And General Motors, I think, is probably a good one to look at. Even though they had a bankruptcy back during the financial crisis, this is probably a good one because it's been pretty steady. And to me, the General Motors price to book value being below 1, that's shown that it's undervalued. And I like this one also because it makes sense also when you look at EV to revenues for General Motors. It's pretty low. Or the price to earnings ratio, it's pretty low. And yes, we're probably going into recession. So maybe these price to book ratios and PE ratios are the cyclical low for General Motors, but I still think it's at a good level here, and it's discounting a lot of risk. So let's go to the next one here. Well, Ed Yardeni, he does great research, and here he has a chart here on the forward price to earnings ratio, and this is a long-term chart. And I like this chart in particular because what it does is it divvies up into different cohorts, the S&P 500, the 400, and the 600. And it's showing that large cap stocks, so while the PE ratios have gone down for them, they're not as low as they were back in 2011 or back during the 2008 great financial crisis. And another long-term chart is a 200-day moving average. And I chose this one in particular because this one shows you the S&P 500 as a percent of its 200-day moving average. And you can see those purple bars are showing that we had come down quite a bit off our 200-day moving average. So that's could be indicating that we're at the bottom. But I don't think we're there yet. I think we're going to go down again and hit and reach that purple bar yet again, like we did. If you see back here in 2008, there was a long period of time where stocks were below the 200-day week moving average. So what's the key takeaway? I think when you're looking at charts or indicators or whatnot or anything, always tell yourself, is this a short-term indicator or a long-term indicator? Because if it's a short-term indicator, it could be oscillating a lot and it could be given a false signal. And if it's a long-term indicator, it's probably a better signal. And also, lastly, are these indicators or charts, whatever, are they given concurrence? Number one, are they concurrent with each other, meaning are the short-term indicators bullish with long-term indicators, and are crypto charts also in concurrence with the equities charts or commodities charts or bond charts? You always want to see concurrence with all these indicators. Well, thank you for listening, and please come again and like us. Bye-bye.